Hi, everyone. Mike and Jamie here, and today's top 5 will be on diversification. So you've probably heard a lot about diversification, but what does that actually mean? So today, we're going to be covering what diversification actually means in your portfolio.
Sounds a lot of diversification that we're about to talk about. So let's jump right in.
Let's dive in. Okay, starting with number 5, we have geography. What does that mean? What does geographic diversification mean, Michael?
Well, one way we can diversify our investments is owning stocks, bonds, different assets from around the world, not just in one specific country. There's something called home country bias, where statistically, and you could find this anywhere in the world you go, countries in Europe, United States, Australia, people have what's called a home country bias, which means they're more likely to invest more heavily in their own country than they are countries outside their own. And so when we do that, we forego the benefits of diversification. Different countries are impacted by different laws, economic cycles, so on and so forth. So by diversifying geographically, we can reduce our risk.
Well said. All right, let's jump into number 4. Number 4 is quantity, number of things we own. Now, this is probably the most often heard way clients understand diversification, but this is not necessarily true. Michael, why don't you take it away with number of things we own and why that doesn't diversify a portfolio?
That's a good point. Most people typically, when they think of diversification, it's how many things do I own, right?
Yep.
Number of stocks do I hold in my portfolio, ETFs. And while that is important, there's something called company-specific risk. For instance, in the stock market, if we put all of our investments in one business, if something could go wrong for that business and the market could be just fine. And so we want to have a certain level of diversification across a number of investments we hold. But, at a point, for instance, in the stock market, and we've got some data from the CFA Institute, in the large cap US equity universe, for example, once we get beyond 15 up to 20 stocks in a portfolio, assuming they're in different sectors, we're getting almost 95% of the diversification of the market. Now, we could add 500 more, 1,000. We're not getting any more diversification from a company's specific standpoint. Moreover, a lot of times it's typical when we're looking at prospective clients' portfolio. They might own dozens of different ETFs. Each of them own hundreds of different things. The portfolios lack focus, and we're basically owning things just to own things. We might as well own an index fund, which there's nothing wrong with that. But when you're owning many things that have higher expense ratios and you've got an index-oriented portfolio, it's not a recipe for success.
Yeah, and this isn't just based on our opinion, this is based on data. So the graph that we just threw up on the screen, that is pure data of the number of tickers you own does not necessarily mean more diversification. So we've reviewed hundreds of portfolios, and we have seen someone who had 40 funds way less diversified than somebody who held 4 funds. So this is just the data behind it. Just make sure that the number of stocks you own is not what you are relying on entirely in order to be diversified.
Well said.
That brings us to our next point, our next topic in our top 5, which is number 3, tax diversification. Michael, what's the big deal about tax diversification?
Yeah, tax diversification describes the treatment of the assets in different types of accounts. And really, broadly speaking, there's 3 primary types of investment accounts. Now, we've got a whole nother set of videos on custodial accounts, so on and so forth. But for the typical person, you're going to be dealing with IRA or 401k, traditional, as we would call them. These are going to be pools of money that you didn't pay tax on when you contributed to them. And when you pull from them, the IRS says, hey, Jamie, Mike, Cooper, you now have to pay taxes on those. Those are going to be taxed at earned income rates. You have taxable brokerage accounts, which are going to be taxed at capital gains rates, interest income rates, so on and so forth. They're taxable as the events happen within the account, whether it's a realized gain or dividend or interest payment received. And then we have what we would call like a Roth account, which is opposite of the IRA in that we're taxing the contribution that goes into the account, but it can grow tax deferred and be spent tax-free in retirement. And so when we look at someone's assets, it's not uncommon, especially if they're coming into us as a prospective client, that they might be overly allocated to something like a traditional IRA, 401k. Maybe of their investment assets, it's not abnormal for that to be upwards of 80% of their total assets. And that's great. They were able to set aside money in their working years, not pay taxes on the investment as it's grown. But occasionally we'll sit down from across the table from somebody and they have $4+ million, a lot of money in these accounts. and they don't have any other types of assets proportionally to offset the tax impact of taking withdrawals from that. And so what that can look like in retirement, for example, if someone's of RMD age, they may be required to pull out upwards of 4.5% of that account per year, and they don't have any discretion on doing that. The IRS says, okay, you waited long enough, now you have to start pulling that out. Like, think of it as kind of a tax bomb, because frequently the case that we'll see someone that has higher income in retirement than they did in their working years because of this. And so diversifying your assets so that you have some in taxable accounts, IRAs, Roth IRAs, even rental properties that are all taxed differently, we can reduce the tax burden for clients much more effectively, because we'll look at the IRA, well, we're going to be up at this marginal tax rate if we take this level of distributions, we'll switch to this bucket, so on and so forth.
Yeah. And that's a great point, because when you're in your working years, you're just trying to save as much for retirement as possible, right? And so a lot of times that tax bomb or the concentration of which account you're putting that money into doesn't really occur to us, right? Because we're not super future minded. We don't know what that, like Michael said, which I love this analogy, that tax bomb is going to look like down the road, okay? So when we build financial plans for our clients, if you're still in your working years, 40s, 50s, maybe, we columnize every single year of your life until the day you die. So we can see the tax consequence from the RMDs, how that affects your Social Security. You're going to be taxed more in Social Security, or you're going to have IRMA and Medicare. You're going to have a surcharge there because the IRS is demanding you take out so much money for RMDs, et cetera. So all we're saying is just be very aware of what tax bucket you are putting your money in. And we have 3 buckets that you can put your money in, which is taxable, tax deferred, tax free. And just be aware that your future taxes, I don't know who thinks taxes might be going down in the future, not us, but your future tax bracket could be wildly affected by what you do today. So just be wise and smart in where you're putting your money today. And if you don't know what the right answer is, come see us. We'd love to help you with that.
Great point.
Okay, let's pop into a number 2 on our top 5 for diversification. And this has everything to do with time diversification. What do we have to say about that, Michael?
Time diversification is kind of an interesting way to think about diversification, but a great example of this would be dollar cost averaging into a 401k. We're not taking a lump sum of money and putting it all in a single investment at a single time. It's unpredictable what's going to happen then, markets at any given point in time, but we're going to spread our investment over a number of years. And what that does for us is create time diversification. We're not buying at the low point. We're not, putting all our money in at the high point. But over time, as markets go up and down, that actually works in our favor. We're taking a fixed dollar amount of every paycheck, putting it in our investments. When they go lower in value, each fixed dollar amounts proportionally buys us more of that investment. When they go up, we buy less. So over time, we get a lower average cost. And that's really what time diversification is all about.
Yep. And if you are already dollar cost averaging into your 401k, just to tie it into the tax diversification, it would be worth your while to ask your HR if they have a Roth portion of your 401k. That may be right for you. We recommend it to a lot of our clients. Again, you can talk to your financial advisor. Okay. Number 1 brings us to our number 1 diversification topic, which is correlation.
Oh boy, yeah.
What in the world does that mean, Michael?
Well, it was hard not to talk about this when we were talking about the number of things you own, because that is important, the number of things you own. You don't want to be too concentrated in one particular company, for example. But, once you're at a certain level of diversification with regards to the number of things you own, it's critically important that you pay attention to the correlation of those assets. And what that means is, how do they move together? Do good and bad times come at the same time? Are they exposed to similar risks? And this is something that we take great pride in analyzing, looking at our portfolios in a thoughtful manner to ensure that, yes, we're trying to achieve the rate of return our clients need to make their financial plans work, but incorporating assets that have relatively low correlation to each other. This can be described as only free lunch in investing, really. If we can find a set of assets that, let's just say they have an 8% expected rate of return, but they have no correlation to each other, we can incorporate 1, 2, 3, 4. We don't lose the 8% return over the long term, but what we do is we dramatically decrease the risk that we're taking, the standard deviation or volatility of the portfolio, to get technical, in a way that meaningfully can improve the experience that you have as an investor. And for our clients, one of my main goals, when we're building portfolios, is to help them stay invested, to understand, okay, not all of my eggs are in one risk bucket, so to speak. And so this is something that I think is underappreciated, where A lot of folks will look at, I own so many things, I'm diversified. Yeah, but they're moving, in correlations, just not to get overly technical, but they range from -1, meaning they move in the opposite direction of each other. If one goes up 1%, you would expect the other to go down 1%, to 0, which means they're non-correlated. There's really no way you could look at how one investment's performing to predict how the other investment will perform. And positive would be +1. And so for us, when we're looking at portfolios, the closest that we can get to 0, the better. Whereas we'll look at other portfolios for different clients that, we're analyzing, and it's not uncommon that maybe they own 15 different investments, but they have a correlation of 0.9 or above, which means, yeah, you own a lot of things, but you're not really reducing your risk at the portfolio level. So correlation, diversification, critically important, building a good portfolio.
Yeah. And when we review a portfolio, we are not just looking at what you own, but we're really looking at everything you own and how it behaves together. So that is critically important, because that's where the real risk might lie, and then in return where your returns might lie as well.
Yeah, maybe the best example of this in the last few years would have been 2022. It didn't matter, how many stocks you own, where they were in the marketplace. So they all went down to differing degrees. Geographic diversification. If you own stocks, they went down in 2022. Same thing with bonds. And so for a lot of people that held a portfolio that was exclusively stocks and bonds, it was a difficult time. In fact, if you were to look at a portfolio of 60% stocks, 40% bonds, a common 60-40 portfolio, 2022 was a worse year than 2008, the financial crisis. And so, for our clients, they did relatively well because we had other assets outside of traditional stocks and bonds that didn't suffer during the same time frame. And that's really what we're talking about.
Yeah, that's a great point. And as a matter of fact, we have an illustration by Ray Dalio. He is the founder of Bridgewater Associates and creator of the all-weather portfolios. He's famously argued that finding 15 to 20 truly uncorrelated return streams is the holy grail of investing. His research suggests that this can dramatically reduce portfolio volatility without sacrificing returns, and we couldn't agree more. So diversification, just to wrap it up, you guys, the top 5 ways you can tell if your portfolio is diversified is number 5, geographical diversification. Are you invested in more than just U.S. markets? Number 4, quantity or number of items you own. Number 3, tax diversification, very important. Number 2, time diversification. And number 1, correlation. Thank you for joining us.